Hey, Rebel Bankers, this is your host, Chris Noggle, and welcome back to the show. I am really excited about today's guest. Matter of fact, I gotta give you guys a little bit of this. I have Jay Scott, the co-host of BiggerPockets business podcast and the author of 4 books. Specifically, the book we're going to talk about is Recession-Proof Real Estate Investing. And I am really excited to have Jay on with us because we're going to talk about something that, is just so important for all of you to know about. So we'll get into that in just a second, but real quick, I want to talk a little bit about all of your situations, where you're at in your real estate business. That's what I want to hone in on for just one moment. When I got into real estate, I had a lot of misconceptions. I had a lot of ideas in my head that weren't the truth, because you go into this not knowing everything. I always like to say the problem in America isn't what people don't know. It's what they think they know that just ain't so. And I didn't come up with that, just so you know. But let's just debunk a couple things. Money. First off, this is called the Real Estate Money School for a reason. It's because we talk about money in real estate, and we talk about the misconception of everybody thinking I need to have all this money in order to jump into real estate. And that just is not entirely true. You see, in this business, you have something that everybody needs. You have an opportunity that solves people's problems. And that opportunity is the real estate itself. So all you need to do to basically figure this out is you need to get started. You need to take action, and taking action is really the first step. It's not learning everything you need to learn. It's not knowing everything, because you'll never know anything. I've done a couple hundred deals and I still learn every day, and your situation will be the same. So for today, I want you guys to think, and I want you to make a commitment to yourself and also make a commitment to me. I want you to get started. I want you to take action on one thing. Go through, make a list of all the things you want to do with your real estate business, and I want you to take action on one today. And if that one thing is learning how money works, grab a copy of my book, The Private Money Guide. Grab a copy of Jay's book so you don't make mistakes, called Recession-Proof Real Estate Investing, and that's what we're going to talk about. So let's jump right into it. Jay, welcome to the show. I'm really excited to have you on.
Hey, Chris. Thanks for having me. Glad to be here.
Awesome. So real quick, Jay, let's just kind of take the audience and tell them just a bit about your business, what you're doing today, and then we'll take a quick trip back in time and talk about your humble beginnings and how you got started. And then let's deep dive into what's to come and how real estate can help.
Yeah, absolutely. So these days, we actually just made a move a couple months ago from Washington, D.C. down to the Florida area. So we are transitioning our business a little bit. We've always done a lot of our deals away from where we live. A big part of our lifestyle has been trying not to do too much too close to home, because when you do deals that are right around the corner, you spend a whole lot of time actually involved in the details, the day-to-day business. I prefer to kind of work more on my business than in my business. And I'm forced to do that when my deals are kind of 100 or 1,000 miles away from me. So moving to Florida has been nice because it's allowed us to kind of get a little bit more hands off from our deals up in Maryland, our rentals up in Maryland, our flips up in Maryland. But it also opens up some new opportunities down here. This market's a whole lot different than what we've been accustomed to. We lived in Atlanta for a while. We lived in the DC area for a while. Florida's a whole lot different. So we're kind of in a wait and see mode. We're kind of feeling out the market down here to see where things are headed, both from an economic standpoint as well as just a growth standpoint. So Florida, as a lot of people know, is probably one of the fastest growing states in the country, large influx of people. So there are definitely a lot of new opportunities here, but we're doing a little bit of everything still. We're still flipping houses. We're buying rentals. We're doing some multifamily. We're doing a good bit of lending. We're holding notes. So we're always looking for the low hanging fruit. And so kind of status quo here.
Awesome. Well, Jay, I know we talked offline, but for the audience, we're going to be adding 2 to the population of Florida, because Larissa and I are going down, and we're going to get residency down in Florida for lots of obvious reasons, but also to do a lot what Jay spoke about and check the opportunities out. So Jay, real quick, let's tell them a little bit about kind of your humble beginnings. And I don't know a lot either, so I'd like to know,
Sure.
How did you get into real estate? What did you used to do? And, what was that journey like? Did you struggle at all from a money standpoint getting to where you're at today?
So my wife and I were actually really fortunate. We started out in the tech industry. We met back in 2006 in California. We were both doing the tech corporate thing. And when we decided to get married in 2008, she was working traveling 3.5 weeks a month, working 80 to 100-hour weeks. I was traveling like 2 or 3 weeks a month. I was doing the 60 to 80 hour a week thing. And we realized that if we were going to get married, if we were going to start a family, we were kind of later in life. We were in our mid-30s at the time. We knew that we just couldn't keep up the whole corporate thing. We couldn't do the 80-hour work weeks unless one of us gave up our job and stayed home with the family. And we didn't want to do that. We decided that for it to work out for us, we needed to build a lifestyle business around our family. We need to put our family first. So my wife always said, and I always agreed, that we didn't want to miss any piano recitals. We didn't want to miss any soccer games. We wanted to be there for the first word and the first step, and really just put family first. So in 2000, I guess it was late 2007, when we decided to get married, we made the decision. We're both just going to quit our jobs, and we're going to move from the West Coast back to the East Coast, a little bit closer to our families, and figure out what was next. And we had no idea what was next. And summer 2008, we settled in Atlanta, Georgia. This was during the recession, but Atlanta was one of the hardest hit cities in the country at the time. I mean, literally, you drive down the street and 7 out of 10 houses had a for sale or a foreclosure sign on them. It was absolutely ridiculous. Well, we were trying to figure out what we wanted to do. The wedding was coming up, but we took the summer off. And one day we're sitting on the couch in the basement, and my wife's flipping through the channels, and she turns on a flip show on HGTV. Now, anybody that was watching TV back in 2008 knows that every time you turned on the TV, there was some sort of home flipping show. And so my wife's watching this show, and she turns to me and she said, "Let's flip a house." And I thought she was kidding. The first house we had ever purchased was 2 months earlier when we bought our personal residence. But she was serious. She was like, "We have a couple of months till the wedding. We've got nothing else to do. Let's flip a house." And so that kind of started our journey into looking for that first flip. We actually found 3 properties. It took us 6 months to find a property, but when we did, we actually found 3 properties all at once. So within 3 weeks, we closed on 3 properties, which was actually a really good thing, because the first one went so poorly that if we hadn't purchased 2 more at the same time, we almost certainly would have given up. But we bought 3 properties in the first month, and we just kept buying. We did 14 that first year. We did about 25 the second year, and we kept ramping up from there. And it's been 11 years. We've done a few hundred flips, and now we've done rentals, we've done multifamily, we've done some syndications, mobile homes, lending notes, a little bit of everything.
That's awesome. That's a great story. From tech to your second house you ever buy was your flip, and then all of a sudden ramped up like that. And you know what? That's being persistent and consistent and following some type of a system. So why don't we do this? Why don't we kind of deep dive into your book, Recession-Proof Real Estate Investing? So I talk on the show a lot about the markets, being an old financial advisor, 16 and a half years, living the big lie, doing the big lie, and talking to everybody about, the things that today I tell everybody not to do. But the one thing I did as an advisor that was, I guess, fairly unique is I studied market patterns. I studied the indicators, the signs, just the boring nerd stuff that we don't even want to hear about. But I knew exactly what things would trigger different reactions in the stock market, because that was my job. So in doing that, now I'm doing that in the real estate world, and I'm also doing that with my teachings on money. And I'm trying to tell people, like, guys, the bells are going off everywhere. The sirens are going off. There's a hurricane hitting Florida. Well, guess what else is going to hit? The recession or some type of a correction is going to hit soon. Are you ready? Everybody gets ready when there's a hurricane coming to hit Florida. So if you live in Florida, that's just a normal thing. You board the windows up, you pack the animals and the kids up, and you seek safe ground, right? We plan for a weather or a hurricane or some natural disaster, but we think we plan for the market falling. We think we are ready for it, but no one ever is. They're never ready until it's too late. So I keep talking about that. So when you mentioned your book, I was super excited to dive into this. So tell us a little bit about your book, how it came about, because I know you've got 4. So yeah, take it from there.
Yeah. So I did the business school thing back in my corporate career. And so I've always been interested in economics. I've been interested in finance. And so I think the biggest driver of this book, to put it half jokingly, is I'm probably one of the laziest people you'll ever meet. I'm always looking for the easiest way to make money. I don't like to work hard. I don't mind working a lot of hours, and a lot of people think I work hard, but honestly, I'm always looking for the easy way out. And I'm always looking for the low-hanging fruit. I'm always looking for the least amount of stress and the least amount of headaches. And in real estate, I started investing in 2008 through 2015, 16. Things were easy. I mean, I was buying REOs off the MLS and finding literally dozens of deals a year without even trying. Then we did the short sale thing back in like 2011 to 13. Those were easy. Then we did new construction 2013 to 2015 because finding infill lots was easy. Then we started doing some lending because lending got really easy from 2016 to 2008. So we're always looking for the easy thing. And then around 2018, things started to get tough. There was no low-hanging fruit that I could find. Flips were getting tough. Rentals were getting tough. Syndications were getting tough. Finding lending deals. Money was starting to get really cheap. So competing with professional lenders, people just weren't willing to pay the same rates that they had previously been willing to pay. Everything was getting tougher. And so early 2018, I'm looking for what that next low-hanging fruit is, that next easy thing that we can kind of transition our business and keep making money. And I couldn't find it. And that's when my wife reminded me that everything we had done, and my wife and I have been partners in this business for the last 10 years, one of the smartest people I've ever met. She reminded me that basically all of the shifts in our business have been based on economic shifts. So when the market downturned, we were focused on foreclosures because that's where all the deals were. Everybody was going through this economic turmoil and giving their houses back to the banks. Then when the market started to get a little bit better, people wanted to get out from under their houses, and they did the short sale thing, and then the new construction thing when land was still relatively cheap and there weren't a lot of investors in that space. So every time we transitioned our business, it was based on what was going on in the market. So my wife said to me, based on what's going on in the market, where do you think the opportunity is going to be in the next 6 months or the next 12 months or the next 2 to 5 years? And that was really an eye-opening moment for me because it made me stop looking at it from, let's look at the market and try and glean where the opportunities are, and instead look at the economy and glean where the opportunities are going to be. Let's figure out where things are heading and try and kind of converge our business with the economy. So as soon as I made that realization, I said, this is a book. There are a lot of people who are trying to figure out what to do next. And over the past 10 years, we kind of zigged at the right time and zagged at the right time. And it was worth like putting down how we did that and what our thought process is. So I spent a couple of weeks like really just mapping out like at different points in the economic cycle, what are the right strategies to implement from a real estate investing perspective? And then what are the specific tactics that you can implement within each of those strategies to kind of optimize your business for the particular market and the particular point you are in the cycle. And then I kind of said, okay, I'm going to take that and I'm going to turn that into a bigger book that kind of, the first half of the book is going to talk about economic cycles. It's going to talk about how the economy works, what drives it, what affects it, so that people can kind of get a feel for just how the cycle works and they can kind of determine on their own where we are in the cycle. And then the second half of the book is going to focus on, depending on where we are in the cycle, how you can optimize your real estate business to maximize your profits, minimize your headaches, and really take advantage of that point in the cycle. So that's what I was attempting to do. So I sat down, this was the easiest book I had ever written. I love the subject matter and nobody had really written about this before that I had been able to find. I wrote the book in 3 months and I've gotten just a tremendous amount of feedback on it. And people telling me that not just the real estate piece of it, but people telling me just the economics and the economic cycle piece of the book really kind of changed their view of business and investing in general. So from that standpoint, I consider it a tremendous success.
That's phenomenal. And, you're right. There isn't a lot of people writing about it. And, the part of the reason is the only people that would write about a book such as this is usually somebody that came from the financial world that kind of understood that, because it's not exactly an easy topic to understand. When you peel the onion a few times, it's very easy to see these indicators, these cycles, because they've been the same pretty much since back to the Great Depression. It's kind of like just copy what's happened in the past and you can predict what's going to happen in the future with, a little bit of variation in that. So in writing this book, you've kind of mapped this out, but given what's going on right now, and my opinion is we are at the tail end of the bull market. We are literally at the very top. So Warren Buffett always says, buy low, sell high, and don't lose money. Well, we all have been buying low through this cycle from 2009 up till, I guess, now. You're essentially buying high if you're buying now. But then he says sell high. So really the right thing to do right now, if we're at the top, would be to start selling off and positioning yourself in a liquidity state so that you can be ready for the next down cycle and take advantage of that opportunity. But then he says, don't lose money. And that's the part that always gets everybody thrown off. Like they're like, don't lose money. Well, Warren can say that, but like, I'm not Warren Buffett. And folks, it's not about Warren Buffett or how much money he has. It's simple. Do rules number 1 and 2, buy low and sell high, and you won't lose money. It's that simple. Don't overcomplicate it. It's not like Bed Bath and Beyond. We understand the bed and the bath, but what is this Beyond thing? Like, we'll never know. This is easy. Don't lose money. It's just follow 1 and 2. So with that, if we're at the tail end of a cycle, what are you suggesting or what is your book suggesting people do? What strategies will work into this environment that we're approaching, where we're kind of going flat right now, and the next step is probably the roller coaster down?
Yep. So I will absolutely answer that question, but I think there's a piece in between that's really important to cover. And that's the thing that's actually been throwing me a lot the last couple months, talking to a whole lot of people, especially real estate investors who I otherwise would have assumed would have had a pretty good handle on this stuff. I've talked to a lot of real estate investors over the last few months who will talk about an impending recession, and their response is, I don't think a recession's coming.
Same here.
Like that's absolutely a valid response. I'd love to talk more about that, so I'll dive in a little bit more. So when do you think the recession? Well, I don't think the recession's coming. Okay, so the recession's not coming in the next year or two, so you think 3 or 4 or 5 years? No, I don't think we have a recession coming. And so it made me realize that there are a lot of people out there that are missing the fundamental concept of economic cycles. They think of a recession as an optional thing, that they don't get that. And it's simply not being familiar with the data. There are a lot of people that started investing after 2008. They might have lived through the 2008 recession, but they may not have lived through the 2001 or the early 90s, late 80s, mid 70s. They may not have lived through a bunch of recessions. So they don't get from a economic foundational standpoint that economic cycles are pretty much a certainty. And if you look back at the history of this country, and certainly other countries, but just look at the history of this country, in the last 160 years, we've had 33 full economic cycles. So you can do the math. 160 divided by 33, we're somewhere around 5.5 years. Every 5 or 5.5 years, on average, there's going to be a downturn, and there's going to be an upturn, and there's going to be a leveling off. And this cycle typically averages about 5.5 years. I think a lot of people have been thrown off by the fact that we're now 11 and a half years into the current economic cycle. And so we're forgetting, or we never realize, a lot of people don't realize that these cycles are inevitable, and they've always happened, and they will always continue to happen. And it doesn't matter who's president. It doesn't matter who's in Congress. It doesn't matter what's going on in our economy. These cycles are inevitable. And sure, they're not perfect cycles. So some cycles are 3.5 years. This one's 11.5 years. There's going to be variation, but because there's not a recession yet doesn't mean it's possible that there's not going to be. There's going to be a recession.
Absolutely.
And we can absolutely discuss, are we within a month of a recession, a year of recession, 5 years of recession? We can absolutely have that discussion, and we can debate that, but there's really no debating that there is a recession coming. And again, I don't know if it's tomorrow or next year or 5 years later, but there's a recession coming. So then the question becomes, so when's the recession coming? How do we know that the recession's coming? Everybody kind of differs on whether it's next week or 2 years from now. But what can we do to kind of determine how far out we might be? And when we start having that discussion, I like to tell people that from my perspective, there are 3 things we can look at to kind of gauge where we are in the economic cycle, when the next downturn might come. The first is probably the least quantitative, just the most qualitative, and I refer to it as just observation. You look around and there are certain things going on that kind of signal that we are probably towards the top of the market. You have everybody and their brother selling real estate courses. You have everybody and their brother that wants to flip houses. There's this irrational exuberance around investing. People throwing money in the stock market, people throwing money in crypto, people not really thinking about their investments, just throwing money because for the last 11 years, or for not the entire last 11 years, but at least 8, 9, 10 of the last 11 years, everything's just gone up. And so people are just trying to get as much money in as quickly as possible without really considering the investments they're making. So this whole irrational exuberance, this whole everybody investing, everything kind of just feels frothy, to use a word. That's the first piece. When you start to see that, when you start to feel that, anybody that was in real estate back in 2005, 6, 7, they know what I'm talking about. There's this whole just crazy feeling around real estate. So that's number one. Number two is the timing piece. And timing piece goes back to what I was saying before. Typical cycle lasts on average 5.5, maybe 6 years. They've actually been getting a little bit longer over the last 60 years. So we're probably an average of 6, maybe 6.25 years on average. So again, not every cycle is going to last 6 years. Some might be shorter, some might be longer. Obviously, this one's longer. But given the fact that the typical cycle lasts 6.25 years, we are 11 years into this cycle. That tells you that unless you think this time is different, and we can talk about that because there's always people that say this time is different, but unless you think that the foundational principles of economics have changed in the last decade, we're headed for a recession, and probably soon, just being 11 years in. And again, we can come back and talk about what might be different this time, what you can argue is different this time, that might be changing the timing a little bit. But enough said. 6 years is average. We're 11 years in. Timing tells us we're probably pretty close. The last, and what I consider the most important piece, is the actual data. So the quantifiable data. So looking at different pieces of our economy and looking at trends, trajectories, data points, and determining what they mean with respect to where those same pieces of data were pointing in previous recessions. So, I mean, the one that a lot of people are probably familiar with is something called GDP, or gross domestic product. And this is just the total output of our country. How much are businesses producing? How much are consumers consuming? And typically we like to see that number growing quarter over quarter. And typically that growth averages somewhere around 2.5% to 3%. So our economy is growing 2.5% to 3% quarter over quarter. The technical definition of a recession is 2 quarters in a row where that output actually decreases or shrinks. So we haven't yet seen that. But what we have seen is beginning of 2018, tax cuts go into effect, and we saw a big quarter at the beginning of 2018. We were at about, it looked like it was about 4%. That was revised down. We're actually about 3.5% growth. But we were expecting to stick at around 3 to 4% growth for the next couple of years based on the tax cuts. That was a big spurt of the economy and really should have kept our economy going strong for a couple of years based on the magnitude of those tax cuts. What we saw in the second quarter of 2019 is that our GDP growth was down to 2.1%. So we've gone from 3.5% to 2.1% in just a big drop. Now, you can argue that, well, 2.1% historically isn't too bad. It's a good baseline number. We've seen 2.1% through much of this expansion since 2008. But the fact that it's such a big drop since last year, that is showing a trend. So that's the first thing that tells us, okay, things are okay right now, but they may be heading in the wrong direction. The next big one is this thing that everybody's talking about now called the yield curve, or bond yields. And I'm not going to go into a whole lot of detail on what this means.
It gets boring, but it's so important.
It is. The long and short of it is that the government raises money by selling bonds, basically these debt instruments, these pieces of debt. You give the government money and they pay you back that money plus some interest, what they refer to as yield on a bond, over some period of time. And the longer you're willing to lend the government money, the more interest the government's willing to pay. If you're going to lend the government money for 30 years, they're going to give you more interest than if you lend the government money for 3 months. And so historically, if you look at the data points for how much the government's willing to pay in interest, and this is all driven by the market, supply and demand. If you look at how much the government's paying in interest for like a short-term bond, a 3-month bond, it's a lot lower than the 30-year bond. And then we see the straight line from the bottom left to the upper right as you get into longer and longer durations. A weird thing happens when investors get concerned. When rich investors, whether that be individual investors, companies, or even countries themselves, when they start to get nervous about the economy, they start to move their money around differently, and they start to move their money out of certain government bonds, specifically out of the long-term government into the long-term government bonds. Out of the short-term government bonds. That kind of messes up the rates, and that curve that we saw going from the lower left to the upper right starts to flatten out. We see the same interest or yield paid on all the different expirations of bonds. And then when things get really bad, we start to see kind of a U shape where everybody's kind of moving their money into the middle of the road expiration bonds. More money going in pushes the rates down, and so we see this little U, and that's called an inversion. So this line is called the yield curve. The U shape is called an inversion. And so when we see this inverted yield curve, the reason why people care about this is that 90% of the time over the last 65 years, when we see an inverted yield curve, within 6 to 18 months, there's been a recession.
Yes.
So
I think it's every time, actually. There have been
two exceptions.
Okay.
There was an exception back in the 70s. There was an exception back in the 90s, but it's pretty reliable. Now, there's another thing where there's a duration of the yield curve. So generally speaking, the yield curve will invert. And oftentimes within a couple days or a week, it goes back to not normal, but more normal-ish. The inversion is gone. We saw something between April, May, June of this year, which was an inverted yield curve that lasted 3 straight months. Mm-hmm. This has only happened a few times in the last 65 years. Every single time has led to recession within the next 14 months. So again, this time could be different. Maybe everything's changed in the foundation of economics in the last 10 years. But assuming this time isn't different, assuming that history is a good indicator of what's to come, that 3-month inversion in the yield curve is a very, very, very strong indicator that we are likely within 14 months of a recession. So that's the next one. Then you can look at things like wage growth. Wage growth has been pretty stagnant the last few years. That's an indicator that the economy isn't as strong as a lot of people think it is. If you look at certain sectors of the economy, so manufacturing is a good one. Manufacturing has actually had negative growth for the last 2 quarters. So
transportation as well.
Transportation as well. So technically speaking, manufacturing and transportation are in a recession. Those parts of the economy are in a recession. Energy is down tremendously year over year. Tech is down year over year. So there are several sectors of the economy that are starting to struggle. There are some that are still strong, but overall the trend is down. Things are not nearly as robust as they were a year ago. Another big indicator that a lot of economists look at is business spending. So businesses, they do 2 things. One, the amount of money they're willing to spend is an indicator of their confidence in the economy. Number 2, the amount of money that they actually spend drives the economy. So when businesses stop spending as much money, it takes money out of the economy and it actually slows things down. But 2, it sends the message that the businesses, the CEOs, the boards aren't as confident moving forward as they were in the past. Unfortunately, a large part of what drives our economy is sentiment. So business sentiment, CEO sentiment, consumer sentiment. So when CEOs stop spending money, people notice that and people say, oh no, what's happening? I think I'm going to stop spending money. And when people stop spending money, that slows the economy. And so it can be a self-fulfilling prophecy. One of the things that was just announced earlier this week in terms of economic data is that the purchase of luxury vehicles is down tremendously. The purchase of tractors is down tremendously, which means farmers aren't as optimistic as they previously were. And farming makes up a huge portion of our economy. If you live on the coast, you probably don't realize that. But anybody that lives in the middle realizes how much of our economy is driven by farmers. So when they stop buying tractors, That's a bad sign. Recreational vehicles have dropped. People are stopping buying their toys, and they're stopping buying their trucks and their luxury vehicles because they're getting concerned and they want to save that money because they think that negative times are coming, bad times are coming. And just thinking that the bad times are coming is, like I said, it's a self-fulfilling prophecy. It can actually drive that. Plenty of other things we can look at. Bankruptcies have ticked up recently. The stock market has been flat for the last year. I mean, it's up and down, but basically the market's exactly where it was a year ago. Unemployment is still pretty strong. And a lot of people like to look at unemployment and say, hey, look at the unemployment rate. We're still at 3.7%. Everything's great. It's a lagging indicator, which means that unemployment is going to tend to not start trending down until after the rest of the economy leads. And so we shouldn't be looking at unemployment to determine where the market's going. We look at unemployment to see where the market was 2, 3, 4 months behind. Same with real estate. I notice a lot of real estate investors will say, well, the market is so strong, the economy's got to be great. Historically, real estate is a lagging indicator. Real estate typically doesn't get affected by the economy until after things start to turn. Now, what's interesting with real estate, and this is, again, a lot of new investors, a lot of people who are on the younger side, they lived through 2008, but they didn't live through the recessions previously, or maybe just weren't paying attention. But one of the big things I've noticed is a lot of people think, because of 2008, they think that real estate is the thing that drives recessions. When banks start to screw up, when they start making bad loans, when the real estate market starts to fall out, that's what causes a recession. And what people don't realize is, historically, real estate has very little impact on the economy. The economy has a big impact on real estate, but it's not real estate that's driving a recession. So in 2008, it did, and that was an outlier. But you go back to 2001, it was 9/11 that drove the recession and the tech industry. So there was a big bubble in internet back in the late 90s, early 2000s. You go back to the late 80s, there was the savings and loan crisis. So anybody that was around back then knew that there was big banking crisis, nothing to do with real estate. Go back to the 70s, there was big oil crisis back in the mid 70s, nothing to do with real estate. Go back even to the Great Depression, and the Great Depression was driven by, and people hate it when I say this, but Great Depression was driven by tariffs. So government started implementing tariffs on imports, and that messed up the economy. And that was only there were several things that drove the Great Depression, but that was one of the big ones. So long story short, don't look at real estate to try and determine where the economy is heading, because unless real estate is the thing that's driving the recession, like in 2008, real estate's not going to be affected until after the broader economy starts to turn down.
But in this business, when you're in real estate, you're not in it for tomorrow either. You're in it usually for a longer period. So you have to plan for that. So the lagging indicator is almost like putting a blindfold on and pretending you're not seeing what's coming, especially in flipping. If you're flipping houses, folks, if anyone that's listening to this, if that didn't just wake you up a little, if you're flipping houses, you better be planning for a quick exit, and you better be like really planning that exit soon. Don't get into these big old rehabs that are going to take you a lot of time, because you could get caught on the downward cycle. You really could. My prediction, and I'm not going to get into my little fancy charts, but I chart this stuff and I spend nauseating time charting and trying to figure out where is this coming and when is it going to happen. And I got it pegged at 6 to 8 months. I can't ever get it right. And I've been wrong in the past, but I know it's coming, just like you were talking. And I think 6 to 8 months is the max. So anybody that's still riding the wave of the stock market, just look at Warren Buffett. What is Warren Buffett buying right now? Nothing. You haven't even seen the man in any news station. And it's not because he's not trying to be in the news. It's because he's not doing anything. He's literally sitting back, drinking his cherry Coca-Cola and waiting. Because he knows how this works. He's a bottom feeder. That's what he's going to do. He's going to wait for this cycle to go down. And the biggest thing I think that you pointed out that maybe not everybody caught is, folks, don't let this scare you, okay? Just be ready for it, because here's the thing. If you could if you could port yourself back to 2009 and you knew what you know today, how much money could you have made from 2009 to today? Tens of millions of dollars, even if you didn't know what you were doing. You could have, because opportunity presents itself when a market is in turmoil. When a market's going down, that is when opportunity slaps you in the face, because it goes down twice as fast as it goes up. So if you're ready for the downward cycle, it's a party, folks. Like, I got a little Cabana Bar at the top of the roller coaster. Okay, so you guys all have the choice to come to my party. I've got drinks, I've got music, I've got a pool. Join me. But that requires you getting out and sitting on the top and waiting, because you know what we're going to do? We're going to, at this party, we're going to watch everything go down, and we're just going to say, you know what, I think now maybe we'll start getting back in. That's what opportunity looks like, folks. It doesn't always have to be rosy and pretty, and it is what it is. Be ready for it. And if you're ready for it, the rest of your life could be determined in these next few years. You could literally set yourself up for the rest of your life in the next couple of years if you know how to time what's coming very soon.
Absolutely. And I'll also point out that just because and I think you and I agree that we're at the top of the market, maybe even on starting the downturn, starting on the downside.
I'd say we already are.
Yeah. But just because of that doesn't mean you necessarily have to be sitting on the sidelines. Mm-hmm. There are things we can be doing at any point in the market cycle that can minimize risk and still allow us to generate a profit. Now, we have to be a lot more conservative. We have to pick our tactics very carefully. We have to look at our numbers and be sure of our numbers a lot better. But there's still things we can be doing. So let's say you want to be flipping houses right now. I don't necessarily recommend that anybody that's new to this business be flipping houses right now. There are enough risks flipping houses in a good economy. It's not rocket science. Anybody can do it. But now is not the time to try and jump into flipping houses. But for anybody out there that's been flipping houses for a couple of years, they've got 5 or 10 deals under their belt, and they say, I've got this cash. I want to be doing something. I don't just want to be sitting on the sidelines. There are things you can be doing. And so like if somebody wants to flip a house, this is what I'm going to tell them. Right now, 1, keep your projects really quick, because if the market starts to turn, you might have a month or 2 or 3 before you really get stuck and have to dump your property. So if you can get a property done in a month back on the market and sold in 2 months, you're going to be it's going to be a lot less risky than if you're taking on a new construction project, a project that requires 6 months worth of permitting, project that requires zoning variances, a project that requires additions or major renovations. But if you're doing really quick projects, you're somewhat mitigating that risk.
Yeah, wholesale deals, quick paint and carpet deals.
Absolutely.
Just get it out. Do what the banks are doing. Mimic the banks, because that's what they're doing right now. They're taking those foreclosures, slapping some paint, throwing some carpets, and saying, "Fixer upper, here you go. Chip and Joanna will come and help you do your house."
Exactly. Here's the other thing I'm telling people. Know your market. So I know that in Maryland, where I'm still doing a few flips, back in 2008, the market dropped about 16%. So I was in a very good part just outside of DC that got hit, just compared to the rest of the country, didn't get hit very hard at all. So our prices dropped from high to low about 16%, which is still a decent hit, but a lot less than much of the country. If I assume that 2008 was probably the worst I could expect, and certainly 2019 or 20 or 21 could be worse, but let's assume 2008 is about as bad as I expect things to get. And let's assume that I think that the fundamentals of the economy in that part of the country where I was hasn't changed much in the last 10 years. I could probably say the worst case scenario for the housing market in that part of Maryland is a drop of about 16%. If I'm willing to assume all those things, I can then say, as long as I'm doing flips that generate more than 16% returns, if I'm doing a flip that's anticipated to generate 20% or 22% returns, the worst case scenario realistically is that I break even or I make a little bit of money. So what I like to tell people is know what happened in your market in 2008. Know what happened in your market in 2001. If the market dropped 50% in 2008, well, you probably shouldn't be doing flips right now. But if the market dropped 20% in 2008 and you can find a deal that's generating 25% returns, you're probably a lot more safe than in a market where you saw 50% downturn. So that's the second thing. Know your numbers, know what the market is likely or worst case likely to do, and make sure your numbers exceed that worst case scenario. Number 3, be willing to get out quickly. The biggest mistake I saw people make in 2007, 2008 was they chased the market down. So they had a property, it was listed for $200,000, didn't sell. The market started to drop. They said, okay, I'm going to drop it down to 198. Market dropped a little more. They dropped it to 195. Market dropped. They dropped it to 190. And they just kept dropping as the market dropped, and they never quite caught up to where they needed to be to get the house sold. What I tell people is if you see the market starting to turn, if you see that inventory is increasing or the number of buyers is dropping considerably, price that thing at a break even or whatever you need to price it at just to get out of it quickly, because you don't want to chase the market down. You're going to find in 6 months, you're going to lose a lot more money than if you just price it right now. So make quick decisions. And then the last thing I tell people, if you're doing flips, always have a backup exit strategy.
Yes.
So if the flip doesn't work, I like to take on flips where I know that if the flip doesn't work, I can turn it into a rental.
100%.
I can do a lease option on it. I could do, I don't do sub twos or wraps on the sell side, but if you have a property that you have a mortgage that you might be able to sub to and somebody else can lease it out, there's always backup strategy. So make sure you have 1 or 2 or 5 backup exit strategies if the flip doesn't work out.
That is some great advice. Matter of fact, that's what I call dropping bombs. And, it's funny, like, we're just talking so much the same language. I'm just loving this because this is what I talk about every single day. And you're kind of going a little bit more in the weeds than normally I will, which is great because people need to hear this. And even here in little old Buffalo, where we've never really had a real estate market that went up or went down, it's kind of always been this nice stagnant little thing. We've seen growth. And we're already starting to see the bottom, come out of this. I mean, we're doing tons of deals. So I'm very close to what's happening. And we're seeing our deals spend more time on the market. We're seeing more fickle buyers who are just have no idea what they're looking for. A new build at $100,000, I think, is what they want. And, what we're doing is we're making very quick decisions. So we'll put a property on the market for 30 days. We'll drop price very quickly to try to get under what we think, is a great price. If it doesn't sell, immediately we move to a BRRRR strategy where we're going to take the deal, we're going to throw a renter in there because we're getting great rents. I mean, across the country, renters are paying unbelievable rents. And you know what? When a market goes down, here's the nice thing. When a market goes down, rents will stay stable or sometimes increase because people need housing. It's a mandatory thing. You got to have a house, especially families. So if you have single family houses, you can rent them for unbelievable rents. Then you take the deal to the bank. Now, at the market cycle where we're at the high point, banks are very eager to lend. And they're extremely eager to lend on stabilized properties, a rented property, single, double, 4, whatever you got it. They're very eager to put money into that because they can do an assumption of rents to protect themselves. So they have 2 levels of protection. So if you can jump on banks right now, community banks specifically, and get them to take you out of these deals that you're getting worried about, all you need to do is just sit back and wait. Because if you did it right, if you bought the property right, and like Jay was saying, know what your market is and just buy underneath that. It's all about the buy, folks. It always has been. It always will be. The market and making money in real estate is about what you're buying at, not what you can sell at. So if you bought it right, there's a good chance when you refinance, you can pull all your money, sometimes take a little extra out, and you're in a property for 0 money. That is the perfect BRRRR strategy. Just follow the strategies, time your business and your portfolio to be ready for different strategies. Wholesaling is great right now because wholesaling teaches you to buy right. And once the wholesaling starts drying up, you just need to figure money out and figure out where all that money is and then be ready to start taking your wholesale deals down and wholetailing them or renting them because that's where all the money is going to be made in a downward cycle. And the best part is, and we haven't touched on this yet, when this whole thing happens, 6, 8 months, 2 years, whenever it happens, money doesn't vanish. Money doesn't just disappear. Money finds a safer place to go. It's called the flight to safety. We knew this in the investment world, but we were trained in the investment world to move money to bonds. Bonds are toxic right now. They are not safe anymore. So money is going to have to find different places to go. And you know where big money is going right now? Real estate. That's why you're seeing all these big hedge funds buying real estate. And you can't even make sense of the numbers they're paying. It doesn't make sense because it's not meant to make sense. It's a flight to safety. They're parking their money in tangible, safe assets. And because of that, they are positioning themselves to be ready. So that's all you need to do. You need to understand how money works. So when this money finds a flight to safety, 401ks and IRAs, let's just talk those 2 because there's trillions of dollars there. Enough money in just those 2 vehicles to fund every one of our deals that ever will watch this podcast. If that's where all the money is and that money needs a safe place, we'll learn how to present your deal, your opportunity to the people that have the money in these retirement vehicles so that they have an opportunity to make money. It's that simple, folks. Solve other people's problems And in turn, your problems will be solved. I didn't mean to go long, Jay. It's just that
No.
just did that.
No, and you hit on two things there that I really just want to highlight because there was so much great information there. But two things that I think worth repeating. One, you mentioned community banks. Mm-hmm. For anybody that lived through 2008 and was investing in 2008, 9, 10, 11, they may know that one of the few places that you could still get institutional money was from small local banks, either community banks or what we refer to as portfolio lenders. And portfolio lenders are these real small banks that they don't necessarily adhere to the government standards for lending. They don't have to underwrite by Fannie Mae or Freddie Mac underwriting guidelines. They can make their own underwriting guidelines because they're loaning out their own money, their depositors' money. And because of that, they have the ability to say, we're going to fund a rental deal, even though FHA or Fannie Mae may say, we don't have the appetite for rental deals. They can say, we're going to fund down to a 630 credit score, even though Freddie Mac may say, nope, we need 680 because of where the market is. They can say, we're going to make 15 loans to you this year, even though Fannie Mae says maximum of 4 or 10. Right. They have the ability to create their own underwriting criteria. And if they know you, if they have a relationship with you, if they trust you, exactly, it's the relationship. If they have a relationship with you, they're going to be able to do things that no other banks in the country can do for you. And the key is don't wait until you need that relationship. Start building those relationships now. Go open a bank account and go find a lender. Make sure they're a portfolio lender. You can even ask them, do you do portfolio lending? Do you lend on flips or rentals? When they say yes, say, great, I'm opening an account at your bank right now. Hey, let's talk about if I ever have a deal that comes through, what I need. Introduce yourself to the VP of lending, of commercial lending.
And they're right there in one of those offices. They're not in New York City or Manhattan or LA. They're right there.
Right. These banks have 1 or 2 or 3 or 4 branches. And so their VP of commercial lending is in 1, 2, 3, 4 branches at any given time, probably within 20-mile radius of where you're sitting right now. And go introduce yourself and start building that relationship now, because those are the single best people to have on your team come a downturn.
Absolutely. And our relationship with our community bank started just like that. It was a relationship. I literally said, okay, I want to build a relationship. So I went there and met with them and I said, look, I want to deposit money with your bank. And in turn, I asked those questions, those key questions that were, are you in line with my business that I'm trying to do? Indeed, they were. This is back in 2011. We started with this bank. That bank, and I don't even know the number, but today we have about 70 mortgages with them. And I did say 70, and they'll do way more than that.
Yep.
Because I have a relationship. That's it. I have demonstrated that I am a smooth operator, I'm a safe operator, and that I am willing to build this relationship with them, and they in turn are willing to go deeper and deeper with me. But you can't wait till the market turns. You can't wait till everything falls apart to be like, oh yeah, I got to go to a community bank. You got no shot at that point. You'd have to really be a standout to have them take you in and really want to build it. The relationship starts now. And for so many of today's investors, because I go to so many masterminds and I see this, the problem we're starting to get into is everybody's living behind a computer screen. They're not going out there into the marketplace. They're not building relationships with estate attorneys, with divorce attorneys. They're not building relationships with estate brokers. They're literally sending mailers out, staring at a computer, looking at KPIs, and thinking that parade is never going to end. It is. Relationships will and have always been the backbone of almost every business, especially real estate. If you're not out there making these relationships now, when you need those relationships, they will dry up. They won't be there. So now, like my watch says, it says now, now is the only time. So get out there and make relationships with these community banks, with these estate attorneys, with these divorce attorneys. And just remember one thing. Your relationships you're going to build are based on you giving first. Don't go and meet with somebody and say, hey, beat your chest. I am so-and-so and I am here to save the day. No, you are there to give first. You are there to solve their problem with the bank, make deposits, build a relationship with an estate attorney, solve a problem for their clients, with estate brokers, solve their problem and help their clients sell their house without having to go through the problem of going through realtors and everything else. I mean, that's it. That's the golden rule has and always will be giver's gain. If you give, you get. Just remember that always. Absolutely. So go out there and start giving, and in turn, you will get.
Yep. And then the second thing, I mean, we're on the same page there. And it's like, if there's only one piece of advice I can give to people is it's build relationships, because that's what every business is about, but especially when you're an investor, it's relationships are everything. The second thing that you said that I think is worth highlighting, you mentioned IRAs, self-directed IRAs and private money. A lot of people don't recognize the big benefit of buy and hold real estate during a downturn with respect to lending money. If you tell somebody, look, 2008, you had your money in the stock market, let's say just an index fund, the Dow Jones, whatever. 2008, that the market started dropping. Obviously, it came back. Always comes back if you give it enough time. Took what, 6-7 years for it to come back. So if you held your money in the stock market from 2008 to 2015, you got all your money back.
Yep.
Now, imagine if you would have put your money in real estate. Let's say you would have lent it to somebody that was doing a buy and hold property. 2008, value of that real estate was going to drop. What happened by 2015? It came back. So just like the stock market, it starts here, it drops, and then it comes back. The difference is with real estate, what's happening every month?
Getting paid.
You're getting paid every month because that landlord's collecting checks every month. And there you go. And even if there's a vacancy for a few months and you don't get paid for a few months, I'd rather get paid 6 months out of the year than zero. And with my stock market investment, I'm getting paid zero. Yeah. So real estate is just as safe as the stock market in terms of long-term growth, but it also has that cash flow property as well.
Yeah, and the other thing too that real estate has that stocks don't is an underlying asset. And that asset, no matter what cycle you're in, can be leveraged in one way or the other. And there's a lot of different ways. When I say leverage, I don't just mean a home equity line of credit. There's so many ways to leverage your asset if need be. I mean, it's a tangible asset and they can never go to zero, just so you know that. I mean, it could get wiped out with a hurricane in this hurricane that's coming. As long as you're smart enough to have insurance, you're going to get reimbursed. So your asset is protected. But that stuff is so vital to understand. And the other thing with stocks that people don't understand, and it's really just the reality of what happens. And we learned this as advisors. You know, everybody says if you stay in the market for the long haul, you can't lose money. And that is true. If you stay in the market for the whole cycle, 20 years or whatever, you'll never really lose money in stocks. But the reality is people can't stay in the market because, you know, when they go on that downward cycle, emotions kick in, fear kicks in. You might lose your house. So it's either lose the house or lose the 401k or put food on the table or keep my IRA, right? Which one's it going to be? It's fight or flight. You're going to liquidate your IRA, and it's always going to be at the wrong time. It's going to be when there's no chance of ever making that money back because you have to provide. So the reality is the average person, maybe the wealthy can, but the average person simply can't ride it out for 20 years. They just can't. And it's designed that way where we know, okay? Big money knows they can't. So they're there ready to gobble up. The people that are always going to make, you want to call them greedy, you want to call them whatever it is, they are not. They're just smart. They know what you don't know, and they know how to react. All you need to do is mimic what the wealthy do. You know, Warren Buffett says, and I hate saying this openly, but I'm going to say it, if poor people would just do what the rich people do, they wouldn't be poor anymore. You can hate that all you want, but that is the truth. If you just mimic what they do, you'll be so much further ahead and you'll be able to protect yourself. But we don't, because we follow the herds. Everybody's rushing into education companies. Everybody's rushing into real estate. Guess what? Smart money's rushing out. Or they're not just rushing out, they're doing it different. They're doing it different than you, and they're watching you rush, and they're like, I'm just going to go the other direction. So everything you said in your book, these indicators, these things to watch for, these aren't complicated algorithms. These aren't things you need to have a degree in finance for. These are things, folks, that you see every single day. You're seeing this happen all around you. You're witnessing it. You're actually perceiving this happening, but you're not doing anything about it. And go ahead.
I'm sorry, I didn't mean to interrupt. But
no, that's great.
But I want to touch on that all around you thing. 15 years ago, if somebody would have said to me, where do you get all this? So everybody knows I keep up with this economic data. I post a lot about it on Facebook. And 15 years ago, 20 years ago, if somebody would have said, where do you get your data, your information? I would have said, I read the Wall Street Journal. I read the Financial Times. I read Forbes. I read this. I read that. Today, you want to know where I get most of my data? I go on Facebook in the morning, and I've got 300 people that are posting the articles they found from all these websites, from the Wall Street Journal and Forbes and Financial Times and business Business Week and I mean, all these websites, they're posting articles. I just go on Facebook and start reading these articles, and I'm just as well informed as if I sat down with a cup of coffee in the Wall Street Journal and the Financial Times every day. So it's hard if you have the right network of friends, if you're following the right people on Facebook and you're not, the crap out there. If you're following the people that are putting out good stuff, this information is going to come to you. You can't avoid it. And so you have to actively try not to be educated if you use the internet correctly.
Yeah, this has been awesome. Jay, we could go on all afternoon. Literally, like we could just go back and forth, because it is just such a fascinating topic, one that is so little known by the general public, and they're just, they need to know this, because this is literally the difference between you making it and you having to ride the roller coaster and be, a slave to the finance world and stay on that financial hamster wheel. This is the answer, folks. You just need to seek out the information. The information you need, the financial information you need, it's not gonna come to you. Okay, and if it does come to you, it's gonna be self-serving information. It's gonna be someone selling you something. You wanna learn? Seek the knowledge out. Go on, watch Jay. Okay, go on to his podcast, the BiggerPockets. You guys all know BiggerPockets. It's the business podcast. Watch his podcast. The golden nuggets you'll pick up every day are gonna basically help you make it through this time. Not just make it, it's gonna help you like literally explode. This is going to be your catapult. This is be your breakthrough moment. But you got to just seek it out. Watch my podcast. Watch, that podcast. I could go on anyway. But Jay, this has been awesome. If people want to get a copy of your book, how do they go about getting a copy of that book?
So all of my books are available on Amazon.com. You can do a search there. And they're also available through my publisher, which is BiggerPockets.com. If you go to BiggerPockets.com/store, you can find all my books and all the other BiggerPockets books.
That's awesome. And if they want to just find you on social media, like what would be the best one to use? Facebook, Instagram?
I spend a lot of time on Facebook. J. Scott Investor so facebook.com/JScottInvestor. Again, I hope you'll check out the BiggerPockets Business Podcast on iTunes or wherever you listen to podcasts. And for anybody that wants to get in touch with me, it is j@jscott.com.
Folks, you guys need to take advantage of that. He just gave you access. He just gave you access to everything he was just talking about. And this information, this is great stuff. Coming from someone like even myself who's been in this business a long time, that right there, that is the golden goose. So take advantage of this. And, Jay, I got to just tell you, thank you so much for being on the show today. It was a real honor. And I'm just excited that when this thing drops, that the value people get out of this is going to really help them, with what's about to come. So,
thanks, Chris. I really appreciate it.
Thank you. Absolutely. So for all of you watching this episode, thank you again for joining us at the Real Estate Money School podcast. And again, you guys got to make that commitment. You got to get started and take action. Take action on one thing per day. Make a list. Set a reminder in your phone. Just get going. Stop worrying about gathering all the information that you need to create the perfect plan. That perfect plan will never be perfect. The thing that will make you successful is action and you starting now. So go get them, guys. Thank you for joining us. We'll catch you on the next episode.